whether we are in a sell the rumor, buy the fact style market, or whether we're in a sell the rumor, sell the fact. Traditionally, it's been weak in the last couple of rate hikes. 1999, negative 7.6%. 2004, negative 2.3%. In today's video, I'll be taking you through everything to do with the stock market, crypto markets, and commodities markets right now. And we'll begin by talking about the S&P 500 heat map here for the close, 19th of January, 2022. You'll notice as soon as you see this heat map, there were some deep reds, and they were all in growth stocks. Semiconductors led the sell-off throughout the day. We had Tesla moving underneath 1,000 for the first time, and Apple showing signs of severe weakness, breaking through our 50 exponential moving average that we'll look at a little later. But what was more important was that we saw a sell-off into the close. And this is showing that Wall Street is still committed to this concept of fear into interest rate hikes, which we know are coming. And of course, the big bit of information, which will be shown next Wednesday when the FOMC statement is read. And of course, the Fed comes out and talks. The hour of power, the beginning retail saw the rip or saw some kind of buying pressure. We were up as much as 1% on the Nasdaq in the first hour. And then we did see a little bit of a rally through the middle of the day. And I think this is what we need to be really careful of when we start to see this increased volatility. VIX above 20 as well, the volatility index, is that Wall Street is well aware that many retail traders trade the morning. So we see these early rips coming off futures and then sell-offs. And it was a sell-off into the close. Look at this. New lows formed by the end of the close day. And more importantly, IWM, the small companies, were showing the signs of weakness. And this is really about breadth in the market and showing that this is not just necessarily all about the big growth stocks. It's also about the small cap companies that are susceptible to interest rate movements. So while we're still positive on the overall year, and we've got some great stats to back that up soon, we do think that there could be a little bit of weakness coming through here that may last weeks, if not a couple of months. And we'll talk about that soon. Which sector was the best for the session? Well, of course, it was gold. We've been talking about gold now since November into December. January is the strongest seasonal month of the year for gold, and it finally had a breakout. 1830 was broken. Gold's up 7.16%, often seen as a bit of a hedge in markets, and there was certainly money fleeing into that zone. Also, XLP, consumer staples and utilities, defensive style sectors, we're still seeing money coming into them, which shows you rotation is continuing to occur. And the worst market was semiconductors, down 2.76%. A big, heavy outperformer, possibly some value coming into that at some stage in the future to allow investors to pick up much cheaper prices on stocks such as Nvidia and other very popular semiconductor stocks. We are in earnings, and earnings brings volatility in itself, but so far it has been lackluster. We haven't seen necessarily the banks coming out with the best reports. The market is not liking it, and we do have a big tech stock coming out after the close on Thursday, which is Netflix. This is the beginning of our large tech stocks, so something to watch if you're interested in knowing a little bit more about sentiment driving this market into the rate hikes, into the discussion for the Fed. And speaking of Fed, we've got some great stats here. And I think this is where we're going to have to figure out whether we are in a sell the rumor, buy the fact style market, or whether we're in a sell the rumor, sell the fact. I'm starting to lean towards sell the rumor, buy the fact, as in we know the interest rate hikes are going to start. But let's have a look here at the S&P 500 index performance after the first rate hike. Traditionally, it's been weak in the last couple of rate hikes. 1999, negative 7.6%. 2004, negative 2.3%. And then, of course, 2015, negative 1.1%. That's over 3 months. So, of course, that doesn't show us all of the current variations and movements that will be going on. Of course, the volatility may have been much more over that period, and I do remember it was more. The important part that I wanted to mention here is, though, that we have the next 6 months being overall positive, and while the next 12 months ends up being still overall positive, it can be a bit of a sideways year, as in we're not going to expect necessarily those double-digit gains. But the stats go even deeper than this, because let's say we're in a sell the rumor, by the fact situation. We fall off 10%. We hit the S&P 500 50 exponential moving average, which is a point that we do expect to occur should we see this close under the 20 this week. And then we have the interest rate hike. What other things do we need to be concerned about with the US economy? Well, one of them is unfortunately politics. Whenever we get into these midterm elections and these midterm times, we do tend to see large pullbacks in the market as well. So we've got a double hit combo here. We have interest rates going up, of course, Fed taking away stimulus, taking away tapering, all of these things. And at the same time, we're in a year of generalized weakness. 2010, negative 16% in terms of how bad the market got over that year. Negative 7.4% in 2014, and 2018, negative 19.8%. Now, it's not all bad news, because while there was opportunity, we're still remaining bullish because we don't believe that this interest rate actual hike is going to hurt the market over the medium to long term. There's a difference between understanding whether a crash is something that's going to last for years and turn into a Great Depression, and then whether a crash is potentially, or correction is potentially, a value opportunity. And based on the stats, we would be looking at some serious returns should you be able to time the market correctly to the bottom, find those accumulation bases, and then invest accordingly. The last couple of stats here, 31%, 8.7%, and 37%. So huge V-shaped style returns if you are able to get the right price at the right time. And this is something that we'll be looking at this year. It's the year of the trader and the investor when you're finding key levels. And midterms and an inflationary discussion into interest rates are sure to lead to a lot of this volatility. We also expect volatility over this period of time. It's seasonal. As you can see here, over the last 20 years, the volatility S&P 500 index has shown a huge pickup January into February into March. So while the VIX is on a tear, it does tend to lead to that kind of weakness. And also we tend to see that weakness coming through in the growth stocks, in the tech stocks, regardless of what's going on. So this is really just enhancing the weakness in the growth stocks. And again, if we do see the right things, we see double bottoms starting to form out of the back of March and Feb, and we get that kind of beginning of recovery on things like growth stocks, there could be an amazing April, May return here for the right sectors if you know how to pick them and where you've got to pick them. It's all about trading. Remember to subscribe if you're interested in finding out more about how to spot accumulation bases and also how to spot key zones or areas that markets will generally participate to. Let's begin our discussion about this technical analysis for the 2-year yield. Other than it going up, we will be continuing to watch this almost every single day here on the channel because it's important. We need to understand what the market is actually saying, what the bond markets are saying here about what the Fed should do and what the Fed actually does. Often markets will get overly excited and start to, I guess, go a little bit too ahead of itself in terms of what the reality is. So the Fed's down here, the market's up here. They'll meet somewhere in the middle, and we fully expect that. But it is going to be important to watch the 2-year. Another thing we're going to be watching is the VIX. So for traders in the VIX, they would be happy after the last day of trade. Another 4.65% increase here to 23.84. Whenever the market's above 20, it really means that you need to allocate your different trading styles. Maybe investors come back in trying to find their dip opportunities. And of course, scalpers and day traders start to really have to play the game with their stop losses set, take profits, and being nimble and fast. The problem with swing is that when you're in high volatility, you can see extreme rips with extreme sell-offs, or even extreme rips with smaller sell-offs and then extreme rips again. It can really do damage to your account. So when you're above 20, it can pay to have different trading styles for that type of market. If the VIX is going to go up to 32, we'd probably be seeing a weekly 20 close underneath the S&P 500. And at the same time, that will bring in a lot of algorithmic sells, and we'll talk about that soon. Another interesting thing that's going on right now is you would think, okay, market's going down, shouldn't puts be going up? As in options, put positions be being placed against hedging in the market and weakness? Well, actually, that's not happening. We're seeing an increased level of calls being opened into the S&P 500 and some other stocks. And this is an interesting phenomenon. Some people are saying it's hedging into earnings, which it certainly could be. And on the flip side of that, it just shows that there is still a lot of bullish buy the dip kind of action going on at around these points. So the PCC is dropping at the same time as the market is dropping as well. Something is a little bit interesting here, and it could continue to fall based on those figures. Let's move over to the commodities. Silver straight away. Beautiful breakout in the previous session. We definitely highlighted that here on the channel in the previous video, and we've seen that breakout continue on. 24.1 was its reading, or it's reading right now. Beautiful base formation. Maybe 24.5 or even 25.37 and the next stops for it. And silver continues to look quite strong. So any pullbacks you would think by now are going to be met by some form of buyer demand. Another one that was going through, other than just platinum, palladium, and all those other metals, was gold. Yes, we finally did it. We broke through the 1830 and closed above on the daily. So this green highlight zone becomes an interesting point for buyers. If the market does end up returning back down here and gold moves down, there could be buyers here. And we probably expect that participation zone over the next week to 2 weeks to push us into that 1870 level. Previous resistance will most likely become resistance again. But the great thing about gold is it's in a seasonal right now, which we'll go into in just a minute. So effectively, that 1870, if it breaches that, where's the next stop? 1910. Where's the next stop after that? Possibly even 2000. So there's a lot of runway should gold get fired up and a lot of these commodities start to run. And of course, if the market comes down, sometimes you see Wall Street rotating into gold and gold style stocks. And that is exactly what happened over the last 24 hours. As I mentioned, there are some seasonals around how gold does. You can ignore the percentages a little bit because it's, of course, the average over 20 years. But we do know that December or November, December, January, and February tend to be strong months for gold. And then weakness or sideways action often can happen. And when you're seeing the technical analysis come along with the strength of the generalized month, it can give us a little bit more confidence in those positions. And I think that's a good point of bringing data together with TA, and sometimes you bring fundamentals in as well. If you can bring the Tolly trifecta together, that is a fantastic way of trading the markets. Remember, it's not one thing that's successful. It's understanding the psychology of the market, the stats of the market, and if we can, the figures to do with the businesses that we're buying or the stocks that we're buying. Speaking of businesses, Tesla has gone underneath 1,000 for the first time in a little bit here. The close was a little bit negative. So we haven't actually seen a negative close here around 1,000 really at any point other than over here where it ended up leading into $900. Let's talk about the current trend change here. So we've got that kind of peak to trough to lower peak to potentially lower trough coming up. We've got a rejection candle that came through in the previous session. And like the rest of the market, it's going to be hard for Tesla to hold up at $1,000 if the Nasdaq continues to fall. If we expect the Nasdaq and the S&P 500 to continue to fall, of course, most stocks will drop. And Tesla is not immune to that. It might be doing really well and still holding up amazingly compared to other stocks, but it's not immune to it. I think day traders are going to be very interested in the first couple of hours of the next session on the Thursday, because if we do end up getting some maybe ripper rally or something that happens in the morning followed by some form of shooting star, an engulfing candle on the smaller timeframes, or some turnaround story, there could be a big short off here to the 900. Where do you think Tesla's going, guys? Do you think that it's going back to 900 and our beautiful trend line that we've used now for a few times buying the stock? Is that where you think it's going, or do you think it's going to rebound straight off around this 1,000, put in a little lightning bolt and move back up to that 1110? Let us know in the comments down below. I'll be interested in finding out more about your opinions there. Tesla not looking the strongest on the charts right now. Another one that just put in a serious change of trend is Apple. So here we have Apple. We have a peak, a trough, a lower peak, and of course the lower trough over here. That's gone through the 50 exponential moving average. That's the blue line. It's broken below what is effectively now a double top as well. And if we were taking the technical level for this, we're predicting that idea of Apple back down to the 152, or again, our huge trend line that we've used now for quite some time as a buying opportunity. Here's where the trend line goes back to September of 2020. It's on the 200 daily SMA as well, which would be fantastic, and around that 150 zone. So a lot of psychological levels all bouncing together should the market continue to fall. And Apple often can precursor the continuation because it's the largest company. When it fails or it starts to move negatively, it can bring the rest of the market with it. We cannot underestimate the current price action going on here. Another thing that's continuing to happen is ARKK is declining. Kathy Wood must not be happy with this, or maybe she is if she's buying more. Volume is increasing on the actual fund, probably a lot of outflows currently going on. And we use ARKK to get an idea of hypergrowth's health, and it is not good right now. Valuations are getting much more into line, and this will eventually offer an opportunity, we believe, later on in 2022. It could be the opportunity of the year if we are able to find the base. Currently though, no base has been found. It's continuing to decline. It's underneath the daily 20 moving average, a good signal of at least some form of trend change, and there is no support in sight. And I think that's the important thing. Do we have necessarily huge support? I mean, maybe the weekly 200, which is leaning into around 73, another couple of percent movement, or maybe even the pre-pandemic heights of $60. This is a massive fall from grace. It is not the first time that we've ever seen a very high profile fund manager be in an idea, that idea to excel, it falls off, and then it recovers later. This is a classic case of being able to find the accumulation base, and we'll continue to cover ARK because eventually, I believe, and a lot of you guys in the community think this as well, there will be a turnaround story. We'll hopefully be able to spot it. And at that point, there'll be some interesting technical analysis. For now, though, weakness continues to show across the board. Speaking of weakness in small companies or growth companies, the Russell 2000 break below 210, not a good sign for it in the previous session, and it continues on with this weakness. And to put this in perspective, let's go over to the weekly here. It's not looking good. I mean, it's underneath all of the previous closes. We know that we had the long leg doji here, the high, the low, the open, the close, showing indecision at the support. If the weekly closes like this, I guess it's a decision made, and we continue to probably show that weakness here in the IWM. It is not necessarily easy to short the market. Remember that, guys. We're going to get rip rallies where the market will come back up. It will find really strong strength. Then it will sell off, then it will come up, then it will sell off. It's a time to be nimble, scalping, day trading, and investing at key levels that you like until we form accumulation bases, and we haven't seen any of those yet. IWM does show weakness. It shows that the market, or at least the smaller cap companies, are struggling. The valuations are coming down, all based on interest rates and the Fed policy of tightening. So something to be watching here, not looking good. Many people would call this a Wyckoff distribution with that false break that we really did think that we could maybe do a little bit better last year, and it really now points towards that 186 kind of zone and a big movement down here in this market. Let's move over to the Nasdaq. So the Nasdaq closed at 15,047, right on a key psychological zone. That 15,000 area is a fairly big deal. Daily 200 moving average just sitting behind it. But our trend line is fully fledged broken now towards the downside. We'd have to expect that whenever we see these kind of sell-offs, there could be still more in the tank from it, but there will be rallies met by sell-offs. So the next stop for the Nasdaq from a larger perspective is going to be somewhere around this 14,600. Previous support buying a lot around there. Monthly S3 as well. Something that often doesn't get broken is these monthly pivots. So we might be sitting at least no lower than this, you would hope, for the end of January. And if we go back through history, even over here when we saw that pivot get opened, look at this. The crash began, monthly S3 bounced, okay? Monthly S3 never got hit the next time, and they were so wide after that it didn't occur. Most sell-offs do struggle with the monthly S3. Even here, it came down, hit that zone, and then ended up bouncing off it. So we do need to be aware of that. It's about, how many percent is it away now? This is only about 3% away to the bottom. And I think that maybe even the market's precursor in getting to this point before the Fed meeting on Wednesday. That's a guess. We'll have to find out, but the market does look weaker. Let's move over to the SPY, SPX. weekly 20, weekly 20, weekly 20. This is the one signal that we've had none of since the pandemic began. Basically, the weekly 20 is continuously held up. We know we have the high, we know we have the low, the open, the close, the long leg doji. Once we get a close underneath this, the most logical conclusion is going to be down to the 50 exponential moving average. And this is still the number one index indicator of bearish strength or bullish strength. It's 500 companies, it's very robust, and it shows us really the bigger technicals and the stronger ones. So rather than the Nasdaq, the IWM, the Dow, any of those things, most large traders use the S&P 500 and place their hedge bets, etc. on this. So it's underneath the 20 at this stage, hasn't closed below. If we go to the daily, we're sitting around 4,500. So anything that pulls down to the 4,500 level, we know there's often a little bit of buying around that psychological zone. So we could kind of envision maybe a sell-off here, bit of a rally, possibly even hit 4,600 again, and then sellers maybe to come back in. It is a bit of a seller's market right now, so do expect that rallies will be met with some kind of selling demand at some point. We're underneath the trend line. This cannot be ignored. And at this stage, we're waiting for the weekly close. So that's something that we'll come back to. We'll look at the options on our weekend video, and we'll certainly be paying a lot of attention to the markets. Let's move over to the crypto markets. They are recovering, but a little bit less than you'd think. I mean, if Bitcoin was digital gold, you'd hope that when gold moved, Bitcoin and Ethereum would do better. Look, we did see it come down to the low points. It rallied, or at least Ethereum has partially rallied off this area, but not had much follow through. Look, you guys know, I mean, double bottom could be potential here, but 3,400 is the big resistance area. It's not looking that healthy, and I think Bitcoin is really the one we've got to watch. And here's the problem for Bitcoin, and a lot of people are yelling at me about not mentioning this, and I have mentioned it plenty of times, and that is this giant head and shoulders concept. The left shoulder, the head, the right shoulder. And ignoring the fact that this head and shoulders actually points towards like a $10,000 number if it breaks through 40,000. The key here is the weakness has been ensued, and this is not showing a current rally. So 40,000 is such an important zone. And while I don't think it goes to 10,000 straight away or anything like that, 40,000, if broken below, really exposes that 30,000 again. A lot of people will not want the crypto market at that stage. And good news is it hasn't happened yet. We're still seeing some form of pull-ups. In the previous session, we had a nice bullish hammer, no follow through. So we kind of get this 42,720 area as a nice peak breakthrough that we would like to see as the first stage of smaller recovery. The second stage would be 44,000 plus, and then of course 46,000. So Bitcoin's showing some signs of strength, but just not enough rally, not enough follow through. Every rip, every rally is being met by seller demand. And I think this is a mixture of big whales getting in on the BTC shorts, which is somewhat materially rising, but also the big guys are in this now. We've got, of course, Goldman, JP Morgan, all of these guys are now in this particular crypto verse or crypto sphere, and they are manipulating it, no doubt, with their large options transactions. So I think a big thing in 2022 that we're going to have to do is start to look a lot at the open interest into the options expiration for Bitcoin, for crypto, as that becomes a bigger market. And we do also need to remember that Chinese New Year is just around the corner, a serious point of weakness, at least historically, and we'll bring that up in the next video, so make sure you subscribe, for crypto. We'll go into that. We'll talk about the Chinese New Year and whether it's still a seasonal weakness period. And there's a lot to discuss with this market, but hopefully holds above 40. And at this stage, we're looking for that breach of 42.7 to show us some extra strength coming into the market. As we mentioned in the previous videos, and we'll mention it again, Wednesday, January 26th, we have the FOMC statement, federal funds rate, and the press conference. A lot of eyes will be on this, and the market, to a degree, is being allowed to really trade technically into that event. So will this be a sell the rumor, buy the fact? We'll have to find out which supports we're on at that point. Be careful out there. Be nimble and fast if you're trading. Day trading and scalping tends to be the best in these high VIX markets. And it's all on for commodities, isn't it? Commodities, oil, all these types of things continue to show strength, but specifically that gold move was a big deal. Catch you for now. Thanks so much for subscribing and smash the like button if you can. Bye.